The $6.2 billion mistake that changed everything. Bruno Ixel sat at his desk in London at 4 a.m., staring at his screens with what he believed was perfect clarity. The JP Morgan trader, who would later become infamous as the London Whale, felt calm and rational as he increased his position for the 73rd time in 6 months. His mind told him this was smart trading. His biology told him something entirely different. What Ixel didn't know was that his cortisol levels, the hormone that protects traders from disastrous decisions, were at their daily minimum. His depleted brain couldn't distinguish between genuine opportunity and random market noise. Each position increase felt logical in his biochemically starved state. By the time New York markets opened and his cortisol normalized, he had built a position so massive it would ultimately cost the bank $6.2 billion. This wasn't just poor judgment. This was predictable neurological failure. MIT neuroscientists have now proven what Wall Street has quietly known for decades. Your brain is literally, neurologically addicted to losing money. The prospect of financial gains triggers the exact same dopamine pathways as cocaine. But here's the revelation that transforms everything. The most successful traders on Wall Street possess specific genetic mutations that wire their brains differently. They don't have superior intelligence or extraordinary luck. They have moderate dopamine levels, perfectly balanced, allowing them to see risk where others see only opportunity. This is the reality of trading psychology, where neuroscience meets market behavior in ways that explain why 72% of day traders end the year with financial losses. According to FINRA data, roughly 70 to 80% of retail traders lose money. Only 1% succeed beyond 5 years. The statistics are brutal, but the explanation is clear. Most traders are fighting their own biology with nothing but hope. Your greed operates on a biological schedule as predictable and unavoidable as sunrise. Scientists have identified 3 critical daily periods when trader brains systematically betray themselves: the cortisol crash at 4 a.m., the sugar collapse at 2 p.m., and the loneliness loop between midnight and 2 a.m. During these windows, your ability to assess risk plummets by up to 70%. Internal records from the London Whale case revealed a pattern nobody discussed publicly. 73% of Ixel's catastrophic position increases occurred during 2 specific time windows, 4 to 5 a.m. London time and 2 to 3 p.m. These weren't random choices, they were biological inevitabilities. At 4 a.m., when cortisol levels bottom out, the brain misinterprets biochemical depletion as calmness and clear thinking. It's actually vulnerability masquerading as confidence. The trader sees price movement and makes decisions from a neurologically compromised state. By the time normal hormonal balance returns, the damage is done. The 2 p.m. phenomenon proves equally destructive. Post-lunch blood sugar crashes trigger the brain's desperate search for stimulation. For derivatives traders, that stimulation comes from one source: larger positions. The body's need for glucose translates directly into reckless market decisions. CME data confirms this pattern extends far beyond individual cases. The 4 a.m. trading hour experiences 400% more retail losses than any other period. This isn't market behavior, it's the catastrophic mismatch between human biology and 24-hour trading schedules. Mike Bellafiore from SMB Capital documented this phenomenon with his own traders. One consistently profitable trader became consistently unprofitable simply by switching to the London session. Same strategy, same setups, identical approach, different biological state. The solution was elegant: restrict trading to 9:30 a.m. to 11:30 a.m. New York time. His win rate jumped from 35% to 67%. Nothing changed except respecting his biological prime time. Professional traders don't fight biology, they map it, acknowledge it, and work within its constraints. They identify their danger zones and either avoid them completely or deploy predetermined automated strategies during these periods. The market will always be there. Your cognitive function won't always be optimal. Jesse Livermore understood success better than almost anyone in trading history. The man who made the equivalent of $1.5 billion shorting the 1929 crash also went bankrupt 4 times. Each bankruptcy followed an identical pattern: massive win, dopamine flood, reckless decisions, total destruction. His journals, studied extensively by behavioral economists, reveal the psychological cycle with painful clarity. After his successful 1929 short position, Livermore wrote, "I feel invincible, like the market speaks directly to me." Within 90 days, he had surrendered 90% of his profits. Years later, having rebuilt his fortune, the exact same pattern destroyed him again. This is the winner's curse. Your biggest victory becomes your most dangerous moment as a trader. Imagine your brain as a nightclub where dopamine acts as the DJ. When you hit a massive win, that DJ cranks the volume to maximum. The prospect of newfound riches triggers a surge in dopamine levels, generating intense excitement and pleasure. The party is incredible for approximately 72 hours. Then comes the crash nobody warns you about. Brain scans from Northwestern University revealed that winner's dopamine receptors literally burn out like speakers pushed beyond their capacity. What happens next is neurologically predictable. You need bigger trades, bigger risks, and bigger wins just to feel normal again. 73% of trading accounts blow up within 30 days of their biggest win. This isn't karma or bad luck, it's pure chemistry. The GameStop phenomenon of January 2021 provided thousands of real-time case studies. One software engineer documented his journey from $5,000 to $150,000 in 3 days, a 2,900% return. His Reddit posts chart his neurological decline with documentary precision. Day 1 after the win, I've cracked the code. Matrix vision activated. Day 3, putting everything into the next play. Why settle for $150,000 when I can hit $1 million? Day 7, YOLO'd into 5 different meme stocks. Day 21, account at zero. His final post was haunting. I don't understand. I felt smarter than ever. Every trade looked perfect. That's precisely the curse. He wasn't seeing clearly, he was seeing through dopamine goggles. Every setup looked amazing because his brain needed increasing action to maintain the high. He wasn't becoming smarter, he was becoming addicted. Ray Dalio's Bridgewater Associates implements mandatory cooling-off protocols for exactly this reason. Win more than 5% in a single day, and you're locked out not as punishment, but as protection from your own neurochemistry. Paul Tudor Jones goes further, trading inverse to his confidence. When I feel like a genius, he explains, I trade like an idiot, small, careful, suspicious of my own brain. The professionals understand something crucial. Future you, 90 seconds after a major loss or immediately following a massive win, is your worst enemy. That biochemically altered person will destroy everything current you has built. Long-term capital management brought together Nobel Prize winners and generated 40% annual returns for 4 years. These weren't average traders, they were literal geniuses deploying sophisticated mathematical models. Then they lost $4.6 billion in 4 weeks, nearly triggering global financial collapse. John Meriwether, LTCM's founder, later admitted, "We stopped seeing risks. We only saw our models, our returns, our reputation. Reality became whatever confirmed our genius." According to employees, the partners would begin each day reviewing their positions, up 10 million, up 50 million, up 100 million. These weren't realized gains, just numbers on screens. But their brains made no distinction. They spent phantom profits in their minds, new houses, philanthropic endeavors, legacy building. The unrealized gains felt more real than reality itself. Then social proof amplified their delusion. Every financial magazine featured them. Every competitor copied them. Every investor begged to give them money. The external validation transformed internal delusion into perceived truth. When Russia defaulted in August 1998 and their positions moved against them, they couldn't process risk anymore. They saw only temporary setbacks. Their response was to buy more and leverage more, confident that reality would eventually bend to their will. It didn't. The Federal Reserve had to coordinate a bailout to prevent systemic collapse. These weren't idiots or amateurs. They were victims of reality distortion at industrial scale. But this exact pattern destroys retail traders every single day. During the 2021 cryptocurrency bull run, the cycle repeated endlessly. A trader sees Shiba Inu moonshots on Twitter, $1,000 becoming 1 million in days. His brain accepts this as normal, possible, even expected. His brain immediately owns this money, spends it mentally, depends on it emotionally. Price pulls back to $8,000 profit. Logically, he hasn't lost anything. Psychologically, his brain screams thefts. Someone stole $2,000 that belonged to him. He checks Twitter again. More screenshots, more millions. His $8,000 feels like poverty. The combination of phantom loss and social proof creates unbearable pressure. He doubles his position, then triples it. Not from analysis, from distortion. He's not trading reality anymore. He's trading a hallucination. Research involving 807 experienced traders proved the danger empirically. Investors presented with upward social comparison take more risk, trade more actively, and report significantly lower satisfaction with their own performance. Your brain treats unrealized gains as real money. Loss aversion makes every pullback feel like theft. Add social proof, showing bigger wins, and you get a cocktail of complete delusion. The cure is brutal but simple. Hate your profit and loss displayed. Unfollow profit screenshots, and judge trades exclusively by process rather than by the highest point they reached. Reality distortion warps judgment invisibly, making it perhaps the most dangerous psychological trap in trading. Nick Leeson didn't destroy Barings Bank with one catastrophic decision. He destroyed it with 180 consecutive small decisions that felt rational in the moment. Average position size in trading accounts increases 400% in the 60 days before account destruction. This isn't sudden gambling, it's gradual normalization, like eyes adapting to darkness. Slowly, then all at once. Leeson started as a clerk at the 233-year-old bank and worked his way to trader. Internal records revealed during the investigation show the progression with mathematical precision. Month 1 hides a £20,000 loss. Manageable, recoverable, nothing to panic about. Month 2, unauthorized trades reach £200,000, still potentially recoverable with one good trade. Month 6, £10 million. Brain completely normalized to the escalation. Month 14, £827 million. Twice the bank's entire capital. Leeson later wrote, "Each increase felt small compared to the last size. My brain couldn't see the absolute madness anymore." Jerome Kerviel at Societe Generale followed an identical pattern, documented precisely in court records. Week 1, €100,000 position, unauthorized but successful. The dopamine hit was real. Week 4, €1 million, just 10 times larger, reasonable, his brain insisted. Week 12, €30 million, another small multiple. Week 50, €50 billion, larger than the bank's market cap. His manager testified, "If you showed me the 50 billion position on day 1, I'd call security immediately. But we got there one step at a time. Each step felt normal." This isn't about rogue institutional traders. This is about every retail trader who ever watched their position sizes creep upward without conscious decision. Compare your average position size from 6 months ago to today, not percentages, but actual dollar amounts. If they've more than doubled, you're on the same neurological path that destroyed Barings Bank. The mechanism is always identical. You start disciplined, proper risk management, conservative position sizing, but wins breed comfort. Comfort becomes confidence. Confidence becomes recklessness. Just this once becomes the new normal. The new normal becomes unthinkable. Your brain features hedonic adaptation. The reason millionaires don't feel rich, a new car excitement fades. The same mechanism makes yesterday's large position feel small today. The only defense is external controls, hard stops on position size, maximum daily risk that cannot be overridden, software that prevents you from increasing size without cooling off periods. Successful traders don't trust their future selves. They know their brains will betray them. They use technology to enforce the discipline their minds will inevitably abandon. Victor Niederhofer learned about revenge trading the hardest way possible twice. The legendary trader who turned $40,000 into $20 million had one fatal flaw: he could unaccept losses. October 27, 1997. Niederhofer held short puts on the S&P. The market gapped down. His losses hit $50 million more than he possessed. According to his own account, here's what happened in those crucial 90 seconds. Seconds 1 through 30. Disbelief. This cannot be happening. The market will bounce back. Seconds 31 through 60. Rage building. The market is wrong. Manipulated. Rigged against me personally. Seconds 61 through 90. The transformation. Rational Victor dies. Revenge Victor emerges. He could have closed the position, accepted the loss, and preserved enough capital to trade again. Instead, he doubled down, then tripled his exposure, fighting the market like it was a personal enemy. By minute 15, He had transformed a survivable loss into complete annihilation. Wiped out, zero. The man who had beaten the market for 20 years, destroyed in 15 minutes of revenge. Here's the devastating part. He rebuilt his fortune completely, making everything back. Then in 2007, the exact same pattern repeated. Loss, 90 seconds. Revenge, zero. He later wrote, "Both times I knew within 90 seconds I was about to do something catastrophically stupid, but I couldn't stop myself. It was like watching someone else trade my account while I screamed internally." Neuroscience confirms that after a loss, rational thought decreases by 70% within 90 seconds. Your prefrontal cortex, the CEO of your brain, goes offline. What remains is a wounded animal seeking vengeance, not a strategic trader making calculated decisions. The cascade is predictable and universal. Loss occurs. Brain personalizes it. The market took my money. Identity threat. I'm not a loser. Revenge fantasy. I'll get it back right now. Account destruction. Professional traders implement mandatory loss protocols specifically to protect themselves during this neurological vulnerability. Paul Tudor Jones. After any loss exceeding 2%, I'm done for the day. Period. Computer locks me out. Ray Dalio goes further. Loss equals reflection time, not trading time. 1 hour minimum before I can even look at a chart. They understand something fundamental. The person you become 90 seconds after a significant loss is your worst enemy. That person will obliterate everything your rational self has built. Your only defense is systems that protect you from yourself during those neurologically compromised moments. In 2008, neuroscientists arrived at a major Manhattan trading firm not to study strategies, but to study DNA. 60 professional traders, all profitable for at least 5 years, provided genetic samples. The control group consisted of 54 MBA students, intelligent, ambitious, but not professional traders. The results challenged everything we thought we understood about trading success. The profitable traders shared specific genetic markers. The COMT gene met 158 variant and the DRD4 gene 7, repeat allele. These aren't intelligence genes, they're dopamine regulation genes. Traders with the warrior COMT gene variant process dopamine 40% slower than average. When markets spike, when volatility explodes, when everyone else experiences floods of excitement or terror, these traders feel curious. One study participant, who traded profitably through 2008's chaos, described his experience. When Lehman Brothers collapsed, my colleagues were screaming and panicking. I felt like I was watching a movie, interesting and worth analyzing, but not personal. His DNA test confirmed it. Double warrior variant. His brain literally couldn't generate the same panic response that destroyed other traders. But here's what matters for those without the genetic advantage. The study found that traders who survived and thrived without these mutations had developed workarounds. They didn't change their genes, they changed their triggers. They rewired their dopamine sources from outcomes to process. Dopamine plays a bigger role in the motivation for reward than in the actual reward itself. The genetic elite don't feel less, they feel differently. They derive their neurochemical satisfaction from perfect execution regardless of outcome, from following rules when it's hardest, from identifying setups correctly whether they win or lose. Stan Druckenmiller, who is tested privately and has the mutation, describes trading as solving puzzles. Wins and losses are just data points. The puzzle is what matters. You cannot change your DNA, but you can change your dopamine sources. Brain scans of professional traders show they process successful trades and perfect stop losses in the same neural region, the reward center. The question becomes, what gives you a dopamine hit? Is it the green P&L, the satisfaction of being right, or the craft itself? Tomorrow, celebrate one perfect stop loss exactly as you would celebrate a winning trade. Share it, journal it, feel genuine pride in it. Train your brain that discipline itself delivers dopamine. Richard Dennis designed an experiment to prove trading could be taught. He recruited 23 people and gave them exact rules. The turtle trading system, simple trend following with clear entries, exits, and position sizing. No interpretation needed, no discretion allowed. The results should have been similar. They weren't even close. Curtis Faith, the youngest turtle at 19, made $31.5 million. He followed the rules through 11 straight losses and a 22% drawdown without deviation. Another turtle, given identical rules, identical capital, and identical markets, lost everything in 3 months. The post-mortem revealed why. After each loss, his brain sought novelty. Maybe I misunderstood the rules. The markets have changed since Dennis created this. I'll just adjust the parameters slightly. By loss 5, he had abandoned the system entirely. This is strategy hopping syndrome. Your brain, especially if you possess the novelty-seeking DRD47R gene variant, gets a dopamine hit from new strategies. You're not addicted to trading success. You're addicted to the search for success. Dennis later reflected, the turtles who failed weren't stupid, they were human. Humans want to improve things. Markets punish improvement. They reward consistency. Modern data confirms this pattern brutally. A study tracking 10,000 retail traders found the average trader experiments with 12 different strategies per year. The profitable 1%. They average 1.3 strategies for years, sometimes decades. Mark Minervini, who transformed $30,000 into over $30 million, uses essentially the same strategy he developed in the 1980s. I've refined it maybe 5% over 30 years. Consistency beats complexity every single time. Your brain will fight this truth relentlessly. It craves novelty and the feeling of intelligence. It wants the dopamine hit of discovering something new. But that's not trading. That's gambling with additional steps and fancier terminology. The cure is commitment. Choose one approach. Define its rules with precision. Track 100 trades minimum before even considering changes. Your edge isn't in discovering the perfect strategy. It's an imperfect execution of an imperfect but workable strategy, maintained with perfect consistency. Long-term capital management's Nobel Prize winners averaged 40% returns for 4 consecutive years. Then they lost $4.6 billion in 4 weeks. Their success became their destruction. The plateau trap is insidious precisely because it feels like progress. Small, consistent wins, growing confidence, expanding comfort zone, then sudden catastrophic failure. Internal memos revealed the real killer wasn't Russia defaulting, it was the plateau trap itself. For years of success had rewired their brains completely. Risk models that screamed danger were overruled by confidence. Position sizes that once seemed insane felt conservative. Leverage of 25 to 1 became 250 to 1. Partner Victor Hagani later admitted, "We confused a good run with genius. Every month of profits made us feel more invincible. By year 4, we weren't trading markets. We were trading our own mythology." The plateau trap progresses through 3 stages. First, competence, you develop genuine skill. Second, confidence excess reinforces your methods and beliefs. Third, complacency, your brain stops questioning itself. The third stage is lethal. Your prefrontal cortex, exhausted from years of vigilance, essentially takes a vacation. You stop checking blind spots, stop questioning assumptions, stop respecting the market. The data is terrifying. Traders who experience 6 straight winning months have an 82% chance of a major loss in month 7. Not because their skill deteriorates, because they feel invincible. Paul Tudor Jones understands this intimately. His famous quote, "I'm always thinking about losing money, as opposed to making money." This isn't pessimism, it's plateau prevention. After his best periods, he deliberately shrinks his exposure. Smaller positions, tighter stops, maximum paranoia. "When I feel like a genius," he explains, "that's when I'm most dangerous to myself." The antidote is systematic humility, scheduled reality checks, position size limits that decrease with success rather than increase. Treating winning streaks like loaded weapons, useful but dangerous. If you've experienced 3 winning months, you're entering the danger zone. Your brain is rewiring for overconfidence. What safeguards will you install before it's too late? January 15, 2015, at 3:30 a.m. New York time, the Swiss National Bank announced they were removing the EUR-CHF floor without warning. What happened next destroyed thousands of accounts in under 4 minutes. The franc moved 30% instantly, 30% in a major currency in seconds. Retail traders positioned for easy money watched their screens in horror. 3:29 a.m. Account value $50,000. 3:33 a.m. Account value $170,000. Negative. They didn't just lose their money, they owed their brokers $170,000, FXCM alone reported. $225 million in client negative balances. Alpara UK went bankrupt. Retail traders received legal notices demanding payment for losses exceeding their entire net worth. Here's what's crucial. Every one of these traders thought they were smart. The Your CHF floor was guaranteed by the Swiss National Bank. Free money until it wasn't. During major news releases, your analytical brain goes offline. Data shows win rates during NFP and FOMC announcements plummet to 35%. You're not trading news, you're feeding your brain's addiction to chaos. Your brain on news releases is your brain on cocaine. The same neural regions activate, the same dopamine flood occurs, the same inevitable crash follows. The only difference, cocaine is cheaper. Here's what happens neurologically during a major news event. Minus 60 seconds. Anticipation. Cortisol rising. Heart rate accelerating. Minus 30 seconds. Adrenaline spike. Hands physically shaking. The release. Dopamine explosion. Time distortion. Reality suspension. Plus 30 seconds. Cognitive blindness. Unable to process information accurately. Plus 5 minutes. Exhaustion. Regret. Confusion about what just happened. Professional news traders don't trade the news itself, they trade the reaction to the reaction. Tom Dante, legendary forex trader, waits a minimum of 30 minutes after any release. Let the addicts blow up first, then trade the exhaustion phase when rationality returns. The data is undeniable. Retail traders who avoid news releases completely outperform news traders by 340% annually. It's not about missing opportunities, it's about avoiding guaranteed destruction. Calculate every penny made or lost on news trades over the past year. Include the revenge trades afterward and the FOMO entries. Is it profitable trading or expensive entertainment masquerading as strategy? Paul Tudor Jones has a saying, losers average losers. But the psychology behind why traders cannot accept losses goes deeper than ego-it-s, neural wiring operating at a fundamental level. Jesse Livermore learned this through painful experience. His early career was marked by an inability to take losses. He would move stops, delete them entirely, add to losing positions. His first bankruptcy came from a single trade he couldn't admit was wrong. But Livermore evolved. By his peak, he was famous for heterogar stops. He would enter with 10,000 shares and exit with a 10-cent loss. If price moved against him, a $1,000 loss. Immediate exit. Next trade. A reporter asked why he took such quick losses. His response, I can always get back in. I can't always get my money back. Barclay research revealed why this evolution is so difficult. Brain scans show amateur traders process stop losses in the same neural region as physical pain. Professional traders process stop losses in the reward center, the same as winning trades. Mike Bellafiore from SMB Capital tells this story about every new trader. They arrive disciplined, but they harbor a secret: they've never actually let a stop hit. Their discipline is just good luck wearing a mask. First real stop loss approaching. The excuses begin. News in 20 minutes. This is just a shakeout. I'll give it more room. They move the stop. Disaster sometimes follows immediately. Sometimes it works, which is worse. Now they've trained their brain that stops are negotiable. The professional mindset is radically different. They celebrate stop losses literally. Linda Raschke posts her stop-outs with pride. Perfect execution. Saved 3% by honoring my stop. To her, a stop loss isn't failure, it's data purchase. She paid a small price to learn the trade was wrong. Without that data, she might have paid a catastrophic price. A stop loss is just admitting you're wrong for a small fee. Moving a stop is insisting you're right for a large fee. Which trader survives long term? The one who pays small fees gladly, or the one who pays devastating fees stubbornly? Same person, same strategy. 68% win rate in demo, 31% in live trading. This is the cruelest joke in trading. Demo success predicts live failure. The better you perform in demo, the harder you'll fall in live markets. Northwestern University proved why with brain imaging. Different money activates completely different brain regions. Every proprietary trading firm witnesses this pattern. SMB Capital's data is typical. Demo phase. New traders average 65% win rate. Week 1 live, 45% win rate. Month 1 live, 31% win rate. Month 3 live, 90% washout. Same people, same setups, same markets, completely different results. Brain scans reveal the truth. Demo trading activates your logical centers. Live trading with real money activates survival circuits that predate language. You're not the same person anymore. One documented trader's journey illustrates this perfectly. Week 1, up $100. In demo, this would be $2,000, but this $100 feels monumental. He starts over trading to make real money. Week 2, first real loss of $500. In demo, meaningless. In live, chest pain, literal physical pain. That's groceries, that's rent, that's real life evaporating. Month 1, account at $7,800. Not from bad trades, from scared trades. Late entries, early exits, moved stops. Death by fear, not by market movement. Real money activates your amygdala, the fear center, which hijacks your prefrontal cortex. You can't think clearly because you're not designed to. Your brain treats financial loss like physical threat. Demo is for testing systems, not building confidence. Real confidence only comes from real losses with real money, experienced and survived. Start live with amounts so small they bore you $10 trades, $20 trades. Build your real money neural pathways, slowly. Your brain needs to learn that financial loss won't kill you. Professional traders fund new traders with tiny amounts first, not to limit losses but to build proper neural patterns. Only when you can trade $100 like demo can you trade $1,000. Only when you can trade $1,000 like demo can you trade $10,000. There are no shortcuts through this neurological reality. George Soros said, "I only have one time frame, the right one." Most traders have 5 time frames, all wrong ones. Checking multiple time frames doesn't make you thorough. It makes you schizophrenic, processing conflicting signals that your brain cannot reconcile. Eye tracking studies at the University of Chicago prove traders looking at multiple time frames don't analyze. They cherry-pick their eyes, spend 73% more time on time frames that support their existing bias. Here's what happens in every trading room every day. A trader identifies a perfect daily setup, clear trend, clean structure, about to enter. Then the doubt creeps in. Better check multiple time frames to be sure. 4-hour chart confirms the daily. Good 1-hour chart, sideways. 15-minute chart shows complete opposite signal. 5-minute chart, pure chaos. Now their brain is fractured. 5 different stories playing simultaneously. The original edge on the daily chart is forgotten. Analysis paralysis sets in. Hours later, the daily setup plays out perfectly without them. 300 pips missed because they wanted to be thorough. Paul Tudor Jones trades one time frame exclusively. I found my edge on the daily chart in 1987, still using it. Why would I confuse myself with noise? George Soros was more philosophical. The market has many time frames, but only one truth. Find the time frame that shows truth most clearly. Ignore the rest. Professional traders follow a principle: one time frame, one story, one decision. They understand something neuroscience proves: the human brain evolved for single-threaded thinking. Multitasking is a myth. Multi-time frame analysis is worse. Your brain, faced with conflicting signals, doesn't average them scientifically. It picks the one that confirms your emotional bias. Always, you think you're being analytical. You're being manipulated by your own mind, seeking confirmation rather than truth. The solution is radical simplicity. Pick one time frame. Master it completely. Know its rhythms and fakeouts and personality. Other time frames aren't confirmation, they're confusion. What if mastery of one beat mediocrity at many? What if depth beat breadth? What if simplicity beat complexity? Timothy Sykes posts every trade with complete transparency, exact entries, exits, reasoning. Thousands by his alert service. The results: 5% make money, 95% lose. Same alerts, same stocks, same timing, wildly different outcomes. One subscriber, Michael Good, transformed $1,500 into $1 million. He took Sykes's patterns and adapted them. Different position sizing for his risk tolerance, different times for his schedule, different exits for his psychology. The losers tried to be Sykes trade exactly like him. Same size relative to account, same holding periods, same everything. It's like wearing someone else's prescription glasses and wondering why you can't see clearly. The turtle traders proved this decades earlier. Dennis gave 23 people exact rules, not guidelines. Rules: precise entry signals, exact position sizing, clear exits. 13 became millionaires, 10 blew up. The difference: The successful ones translated the rules through their personality. They followed the system but traded like themselves. The failures tried to trade like Dennis, same actions, wrong person. Your brain isn't wired like your mentors. Different genetics, different fears, different life experiences, different risk tolerances. Copying someone else's trading is like trying to copy their walk. You can mimic the movements, but it will never feel natural. Mirror neurons make us think we can copy success, but trading success requires personal neural pathways, not borrowed ones. You need your own relationship with risk, your own pattern recognition, your own emotional management system. Ray Dalio learned this early. He studied every great trader, tried to copy them, failed miserably. There was a bad version of them instead of a good version of me. His breakthrough came when he stopped copying and started translating. Take the principle, not the practice. Understand why something works, then apply it your way. The mentor mirage is seductive. Someone else has figured it out, just copy them. But that's not how brains work. That's not how success transfers. What if instead of trying to trade like your hero, you learned from your hero how to trade like yourself? What if the goal wasn't to copy but to discover? What if you stopped being a bad copy and started being a good original? Two brothers in Australia start with identical capital, $5,000 each. Same strategy, same mentor. One crucial difference changes everything. Brother A, never withdraw. Compound forever, think big. Brother B, withdraw 50% of profits monthly. Trading must pay me. Year 1 results. Brother A has $25,000 in his account, never withdrawn a penny. Year 2, month 6, crypto flash crash. Brother A watches his $45,000 become $8,000 in one day. The psychological damage is severe. 2 years of work, gone. He enters depression and stops trading. Brother B takes the same percentage hit account, drops to $4,000, but he's withdrawn $27,000 over 2 years, still up $23,000 overall. He keeps trading. Today, Brother A works a corporate job, bitter about markets. Brother B trades full-time. His withdrawals bought a life that supports his trading. His trading supports his life. Never withdrawing creates dangerous psychology. Nothing feels real. Wins don't satisfy because they're just numbers. Losses don't teach because they're just pixels moving on screens. Data shows traders who never withdraw treat accounts as play money. They take 250% more risk. Their brains never connect pixels on screen to purchasing power in reality. Mark Douglas understood this. He forced his students to withdraw monthly. If your trading can't buy a coffee, you're not a trader. You're a gambler with a spreadsheet. The brain needs tangible feedback loops. When trading profits purchase actual items, neural pathways strengthen between good trading and life improvement. The abstract becomes concrete. Professional proprietary trading firms have mandatory withdrawal schedules, not optional, required. Firms know that traders who don't withdraw eventually blow up. They need to feel the reality of their success, to make it tangible rather than theoretical. What changes when you buy your first meal with